Your personal financial goal will be the reason you save money. How you invest will depend on how much your goal is and how soon you will need the money. After completing this video, you'll be able to calculate the rate of return on your investment, as well as understand the risk involved in different investments. To save money, you should stick to the following plan. Make a financial goal, figure out how much you can save per month, determine how long it will take for you to reach your goal. Finally, stick to your financial goal by not spending money on items that are quickly gone. Make your financial goal come faster by saving instead. The power of reaching your financial goal will teach you the rewards of saving. So what is investing? Investing is any sort of savings in a way that earns income. We will take a look at the various types of investment tools throughout this presentation. However, to have a chance to make more income on your investments, you must be willing to accept more risk. Savings accounts are the safest way to save and earn money. Banks offer other accounts that are as safe as savings accounts but have higher interest. These include CDs or certificate of deposits, as well as money market accounts. A certificate of deposit is a deposit in a savings institution that earns a fixed interest rate for a specified period of time. Banks offer CDs for various time periods, ranging from a few days to several years. During the specified time period, depositors may not withdraw their money without paying a substantial penalty. In exchange for your commitment to leave your money on deposit in the CD, the bank pays you a higher interest rate than it pays on a regular savings account. For most CDs, this rate remains the same throughout the term of the CD. In general, the longer the time period of your CD you choose, the higher the interest rate. A money market account is a deposit for which the interest rate changes over time. The bank uses the money to make short-term investments. As interest rates in the economy change, the income the bank can earn on its investments also changes. When rates go up, the bank makes more and will pay you more for your money market account deposit. When banks go down, the bank makes less and pays you less for your deposit. Think about the numbers. Bank A pays you 3% per year on a savings account. Bank A turns around and loans that money to a new neighbor in a mortgage for 8% a year. That loan is 5% profit to the bank. Money market accounts pay high interest rates than regular savings accounts, but they pay lower rates than certificates of deposit. Money market accounts usually require a substantial minimum deposit, often anywhere from $1,000 to $5,000. The major benefit of a money market account is that you may withdraw all or part of your deposit at any time without penalty. Money market accounts, like CDs, generally provide the same insurance protection as savings accounts. The income you earn on an investment is called your return. Rate of return is measured as a percentage of the amount invested. A general rule of investing is the higher the potential rate of return, the greater the risk. If an investment is risky, the potential rate of return must be high to make it worth the risk. Inflation is the rise in the general level of prices, while inflation risk is the danger that money won't be worth as much as it is in the future as it is today. So when inflation is high, you need to have a very good rate of return just to have the same buying power as before. Imagine there is a 3% inflation. You have your money in a passbook savings account earning 5% interest. What is your real rate of return, including the cost of inflation? It is 5 minus 3%, or 2%. What if your savings account only paid 2% interest? Then your actual rate of return would be 2% minus 3%, or a -1 return. Even though you are earning 2% interest in the savings account, you actually have 1% less buying power. Stockholder or shareholders are individuals who own stock. Owning individual stock is like owning a small share of a company. Stockholders receive dividends or quarterly payout of profits by a company to all shareholders. In some cases, stockholders may or may not receive dividends. It depends on if the company is making a profit. Bonds are a form of lending to a company or the government. Just as people need to just as people need money, so do companies and governments. A company needs funds to expand into new markets, while governments need money for everything from infrastructure to social programs. The problem large organizations run into is that they typically need far more money than the average bank can provide. The solution is to raise money by issuing bonds or other debt instruments to a public market. Thousands of investors then each lend a portion of the capital needed. Really, a bond is nothing more than a loan for which you are the lender. The organization that sells a bond is known as the issuer. You can think of a bond as an IOU given by a borrower, who is the issuer, to a lender, who is the investor. Bonds are less risky than stocks, but usually do have the potential to earn as high of a return. A mutual fund is a pool of stocks, bonds, and other securities managed by an investment company. Individuals can buy shares of the fund and profit from its investment gains. When you purchase a mutual fund, you own a little bit of those different stocks, so your risk is lower. An index fund is a type of mutual fund with a portfolio constructed to match or track the components of a market index, such as the Standard & Poor's 500 index. Stock-based mutual funds own many different stocks. The mutual fund companies pool investors' money and buy a broad range of stocks. An index mutual fund is said to provide broad market exposure, low operating expenses, and low portfolio turnover. Real estate is another type of investment. This includes any residential or commercial property or land, as well as the rights accompanying that land. This can be risky but has a potential for a large return. Examples of real estate investments include rental units and commercial property. The FDIC is a government agency set up in the years after the stock market crash of 1929. It is insurance, and the FDIC member institutions pay for the insurance. In return, customers know that the FDIC stamp on the back or the bank door means their investment is safe. The FDIC, or Federal Deposit Insurance Corporation, protects individual account holders in banks and savings accounts. FDIC coverage currently protects each account holder up to $100,000. This protection means that if the bank fails, the FDIC will pay each account holder the total amount of his or her deposit, which is up to a $100,000 limit. How do banks and savings institutions get this protection? They pay a certain percentage of their total deposits to the FDIC. Are stocks or mutual funds FDIC insured? No, their value can double or go down to pennies, and no insurance will step in and protect their original investment. We have now completed the video. Once you have completed the entire lesson in video, you should be able to understand the various types of investment tools, as well as the advantages and disadvantages to all. In addition, you should be able to understand the concept of the FDIC as well as their purpose in the investment world.